Hello friends, welcome to another episode on Consulting Interview Prep with me, Nilay Bhatnagar. In this episode, we'll deep dive into how to tackle private equity cases. Now, private equity cases are very similar to M&A cases, but there are a few nuances, and that's why I've created this separate video dedicated to private equity cases. So without any further ado, let's dive into how will we tackle private equity cases. Now, the one thing that becomes very, very important for private equity cases is to understand the underlying motivations of the private equity fund or the strategic buyer on whom the case is based, right? So you really need to understand what are the underlying motivations. Why does the strategic buyer or the financial investor is interested in purchasing a particular company? The three most common reasons for why private equity investors or strategic buyers are interested in buying other companies include, number one, turnaround management, right? So this would include companies that are positioned in attractive markets, but they are struggling with their operations, with their strategy, with their talent, etc. So the private equity company comes in, turns around the company, makes them much more leaner, applies Six Sigma, automation, cuts down the cost, cuts out all the fat, and on the revenue side, they reinvigorate some of their core functions such as product development, sales and marketing, distribution, etc. And through these initiatives, they're completely able to turn around the situation of the company. So it's very focused on a particular company that's struggling to perform well in an attractive market, right? So that's the core or the genesis of a turnaround management type of acquisition. The second underlying motivation for private equity companies acquiring other companies is what is called a platform strategy, right? Now, according to some research that was done by McKinsey, a large number of deal value, close to 60% deal value, not the number of deals or the deal count, but a large portion, up to 60% of the deal value actually comes from this particular segment, which is called the platform strategy. Now, what is platform strategy, right? It's a fancy way of saying you're purchasing a company that is well positioned in a growing market, right? So the focus is all about organic growth initially. So it's an attractive company in an attractive market that is doing really well. The goal of the private equity company is twofold. Number one, continue driving organic growth. And this can be done by the private equity company lending capital, resource, introducing that acquired company to different partners, different suppliers, etc. Right? So they are helping them expand into new markets, right? Helping them acquire new customer bases, helping them enter new industry verticals, right? So the focus is all about organic growth and how can the private equity company help the company grow even faster, right? So lots of expansion, lots of capital being laid out. That's the near-term focus. And the long-term focus then becomes additional growth through strategic M&A, right? Or you buy additional companies that becomes add-ons to this platform, right? They complement the platform. They start adding synergies to the platform. So that's the more long-term potential. But initially, when you're purchasing this company in this platform model, you are excited about a company that's doing really well in an attractive market, right? So it's already growing pretty fast, right? It has a solid customer base. It has got a really differentiated product, etc. So that's the second type of private equity case that you can expect. And the final one, I think this is the one that most people are the most familiar with, which is very similar to what M&A looks like. This is about acquiring an add-on company, which then can realize synergies with a platform company, right? So this would be a company that you acquire, but from an angle of maximizing synergies with existing portfolio companies. So this could be revenue synergies, cost synergies, other synergies, but the focus is on synergies, right? So hopefully that gives you an idea about the underlying motivations of why private equity companies go ahead with these acquisitions. It's a super important clarifying question that you must ask, right? Because this will completely change your structure depending on what is the underlying motivation, whether it's turnaround management, whether it's platform strategy with a focus on organic growth, or whether it's an add-on strategy which focuses on realizing revenue and cost synergies with an existing portfolio company or a platform company. Right? Now, I have marked focus for today as the last two variants, but don't worry, we'll also cover the first one because I'll frame it in a way that once you understand the answer to this question about the underlying motivation, you can easily pivot between these three different varieties of private equity cases. Okay. So with that said, let's continue moving. I just want to give you a brief overview about these different types of acquisitions before we actually dive into the framework. So let's quickly skim through this. I've already covered most of the things, but still it would be good to quickly cover all of these, right? So as I already said, there's turnaround deal, platform deal, add-on deal. The focus is in turnaround deal, you're fixing a broken business. In a platform deal, you are focused on organic growth, entering a new sector or vertical by acquiring a company. And then add-on deal is adding on to an existing platform to help grow the platform even further, right? So the condition of the asset is underperforming or distressed asset. In a platform, it's a stable, scalable company that's profitable. They already have good revenue growth. They have good cash flow coming in, right? So it's already making money. You just need to help it grow faster, right? Add-ons are also typically fairly well-run companies. They often tend to be smaller in size so that they can be added on to an existing platform, now you can see risk profiles move from very high in a turnaround deal because there's a lot of execution risk, right? What if we are not able to turn around all of the things? This can be quite challenging, right? This requires a lot of grassroots level problem solving, right? Platform deal, because you're already acquiring a company that's doing pretty well. Yes, there is some risk in helping it grow even faster, but you have a good asset to work with, right? And the add-on platform deal could be the lowest risk if you're very clear about the synergy potential between the two companies. Okay, we already covered the value creation levers, operational turnaround, organic growth, revenue cost synergies. You can read the rest on your own. So I'm not going to spend too much time about all of these things, but hopefully this gives you an idea of what are the different types of private equity deals that exist. All right, now let's actually dive into how will we attack or how will we approach these cases. So our approach for private equity cases will be very similar to the approach that was laid out for M&A cases. Right? So we'll evaluate four areas: how attractive is the market in which the target company operates, how attractive are the economics of the deal, right? What capabilities would be critical for value capture, EBITDA expansion, and what are the key risks. Right? So now let's take a closer look at each of these. I'm not going to spend a lot of time on this. This is now becoming very repetitive. So attractiveness of the market is determined by the size, the growth rate, the profitability, and the key market segments within the broader market and how fast each of those segments are growing. Ideally, you would want to see a market that's growing fast and that has supporting headwinds and tailwinds. Right? And the second thing you want to evaluate in market attractiveness is analyzing the competitive landscape. Who are the key competitors? How much market share do they have? What are the set of products and services they offer? How differentiated are they compared to the target that we are considering? Right? Ideally, you would want to see a competitive landscape that's fragmented, does not have high barriers to entry. Okay. So now moving on to the second area, where we'll evaluate the attractiveness of the economics of the deal. Now, one term that you'll have to get familiar with is EBITDA when it comes to private equity deals. This is a term that's used very commonly in this industry, EBITDA and enterprise value to EBITDA ratio, right? This is a metric that's very commonly used. And it's also used as a means to figure out how much multiple expansion would we need and in what time frame. All right. So don't worry if you don't understand EBITDA and EBITDA multiples. We'll cover that as well. But this is a key term and therefore I'm just bringing it up. Now the economics of the deal again will depend on two things. Right? The first, standalone attractiveness of the target. This is very similar to what we did in an M&A sense, where we look at their existing revenue growth, their cost structure, their profitability, their capital structure, etc. And then we look at some strategic factors, right? Like how loyal is their customer base? Do they have like specific technologies, products, intellectual property, right? Do they have the right kind of talent, right? That makes them very attractive, right? So that will determine the standalone attractiveness of the target. Now, moving on to the synergy or ways to add value. Now, this will change depending on the motivation of the company, right? And you have to just be mindful of how you frame this bucket depending on what you learn about the underlying motivation of the client, right? So, for example, if it is a turnaround management kind of case, right? Here you would talk more about revitalize on the revenue side. You'll talk about more about revitalizing your core functions, right? There would be no synergy, so you're not going to talk about a lot of synergies in this case because it's turnaround management case. But what you will talk about is what are the levers that can be used to optimize revenues and reduce cost for this company, and these levers will be very similar of the levers that you would use in a profitability case: how to grow revenues and how to reduce your cost. So when you're turning around a business, right, you always start by focusing on the core business and then move into non-core areas. So the focus in a turnaround management deal is always fixing your core business before you even think about expanding beyond the core, right? And fixing the core business involves doing some product enhancements, not like full-fledged new product launches. It involves revitalizing your sales and marketing functions. It involves rethinking your distribution strategy, right? It involves ensuring that you have good, stable, just-in-time supply chain so that you do not run into stockouts, right? And lose revenue that way. You ensure that you're doing the right kind of pricing. You're pricing your products and services optimally. So that's how you revitalize your core functions, by looking into pricing, sales and marketing, distribution, your supply chain, etc. And if you have any confusion about this, please go to this channel, and there is a separate video on how to increase profitability. Go to that video, and that will give you all the details about how to increase revenues and how to reduce costs, right? So that's how this would look if it was a turnaround management case, right? If it was a platform based case where the focus is more about growing or increasing the rate of growth, right? This is where you will now start talking more about capital injections on the revenue side, capital injections for accelerated operational expansion, right? So you are moving into new geographies, new markets, new industry verticals, right? You are upselling to your existing customer base, right? You are doing new product development, completely new product launches, right? So now your focus is more and more shifting away from the core, because the core you're doing, but you're also trying to expand beyond the core in form of new geographies, new industry verticals, new product development, and then also doing some strategic M&A to further enhance the value of your offering for the customers, right? So that's how the revenue side will look. And on the cost side, here again, it could be like, just applying simple cost levers: consolidation, renegotiation with your suppliers, streamlining of your operations, process redesign, etc. Right? And now finally, if it was actually an add-on case, and this is where this will start looking very similar to an M&A synergy case, right? You will look at the revenue synergy potential between the two companies, like the add-on company and the platform company or other portfolio companies, and you look for cost synergies, right? The revenue synergies could be in the form of cross-selling, maybe increased pricing power, enhanced product service value proposition, right? Because now the combined entity is able to offer something even more valuable to the customers, right? So this is how you have to really adapt this particular bucket depending on the answer to the question about the underlying motivation of this acquisition. Okay. And finally, once you've done this, you should be able to come up with a standalone value plus the premium for EBITDA expansion potential, and this will give you a fair value deal, right? Now, just one quick thing before I move on to the next part is, remember, there are 3 areas of value creation in a private equity deal or an M&A deal. Number 1 is revenue growth, right? You're growing your revenues faster. Number 2 is margin expansion or EBITDA expansion. This is where you're cutting down your costs and increasing your margins. And number 3 is multiple expansion, right? Remember this, multiple expansion is not directly in your client's control. It depends on macro environment, right? Think of it as in certain environments, investors are ready to pay a higher multiple for acquiring a company, right? For example, when it's a bull market in the stock market, the valuations of the company are high, typically higher, and investors are okay with purchasing companies at higher valuations, right? So what private equity companies try to do is they try to buy these companies at low multiples, low market multiples, and they hope that over the course of the life of this investment, the market sentiment will improve and they will also be able to gain a market multiple value expansion. In fact, historically, this has been the second biggest value creation lever in private equity deals. The first was revenue growth, that accounted roughly 50% of the value creation. The second was multiple expansion, which accounted for roughly 40%, and the remaining came from margin expansion. Right now, things are changing because the macro environment is changing, and multiple expansion no longer is as big an opportunity as it used to be. So the companies are now again shifting focus to margin expansion and cost cutting, and of course revenue growth. Okay, so hopefully that clarifies how will we think about the economics of the deal. Now let's move on to the capabilities that would be critical for value capture. Right. So again, we don't have to get into a lot of capabilities here, but a few things are very critical, right? For private equity investors, the financing of the deal is a critical capability. You need to know, have you already raised the funds? Who are the limited partners or LPs as it's called in the private equity jargon? Who are the LPs who have already expressed an interest? Right? Is it going to be a structured LBO leverage buyout kind of deal, or are we using different financing models? Right? You don't have to get into all of these specifics, but the bottom line is, how are we going to finance the deal? Have we secured the funding that we need to fund this deal? Right. Now, the second key capability is value delivery and management. Right? So you have to be very, very agile. You have to be very active, and you have to very closely monitor how your initiatives are progressing. What are the key roadblocks? How can they be alleviated? Right? The leadership needs to be informed of how we are capturing value. The investors need to be informed of how we are capturing value. How are we progressing against our plans? There needs to be a clear value creation plan that needs to be created, and there should be absolutely robust monitor or progress tracking of how we are progressing against the value creation plan. Right? And this is generally done through formation of a central team or a war room which oversees all this initiative delivery. Right? The third thing is change management and communication. Again, you have to inform everyone, your internal stakeholders, external stakeholders, about what's coming, what kind of changes can they expect, etc. Capabilities, talent retention, and organizational design. Right? Again, you don't want to lose the key talent. So you want to remove ambiguity. You want to provide clarity to the people. What is going to be their role and responsibilities in the new organization? What are the reporting lines, right, etc. So the sooner you can provide this clarity, the easier it becomes to retain talent. Right? And finally, you also need to talk a little bit about like how we're going to exit this. Do we have like a clear plan? Are we going to find like another strategic buyer, another private equity investor, etc. So those are the key capabilities that would be absolutely critical for value capture from this deal. And finally, we'll wrap up by quickly talking about a few risks. Again, the key risks are going to be this turnaround or synergy or integration related risks. Right? So cultural issues, poor integration and planning, weak strategic rationale, etc., etc. Something very, very similar to what we saw for M&A, and any opportunity costs that come with this. Right? So just to summarize, for any private equity case, we look into 4 areas. But before you create your framework, please remember to clarify the underlying motivation of the client. Right? You have to understand whether they want to turn around this company, whether they're looking for a platform with organic growth as the main theme, or whether they're acquiring an add-on to realize synergies within existing platform. Right? Once you have the answer to that question, you can move on to this framework, which has been broken down into 4 parts. Number 1, how attractive is the market in which the target operates. Number 2, that attractiveness of the economics of the deal. Number 3, the capabilities that would be critical for value capture. And number 4, any risks related to this deal. Okay. That brings us to the end of this particular approach. But before I end this video, right, I just want to quickly show you a couple of facts and figures from the most recent Bain report on private equity or the global private equity markets, right? So let's take a quick look at what's happening in the private equity world. A couple of slides, right? So this is focused on software buyouts, right? But what is very, very interesting is look at what has been happening, right? Companies or these deals are consistently, number 1, under delivering on the projections, right? So on the revenue, the CAGR projected was 10.9% or close to 11%. They were only able to realize 9.4% growth. And it gets even more crazy for EBITDA CAGR, right? They project growth of 15.6%, but they actually only realized 8.2%. Almost half of what was projected. And this is the biggest issue with this deal, as I was telling you. You project a lot of stuff, but when it comes to your ability to actually realize all those projections, most of these deals are falling short. And especially on the EBITDA side, on the cost-cutting side, right? Look at the difference. That's huge. And that's why the integration is a huge risk in these kind of acquisitions. Let's take a look at another slide. I covered this briefly, so I won't spend too much time. This is what I was saying, right? The value in these deals is coming from revenue growth and multiple expansion. Multiple expansion, as I told you, is tied to the market conditions, right? How much are the investors willing to pay? At what multiple are they willing to buy this asset? It has got nothing to do with how well you have done. Revenue growth and margin expansion are in your private equity firm's control. And they've done pretty poorly on margin expansion, right? All right, so hopefully you enjoyed this lesson on private equity. As next steps, I would strongly encourage you to create your own recipe, apply it to multiple PE cases. I'm sorry, my apologies. It says M&A cases, but it should actually be PE cases, and then refine and finalize. Okay. As a follow-up to this video, I'm going to create an example where we apply what we've learned today to a real McKinsey or Bain case. Right. Till then, goodbye and take care.